The upthrust. Now this is important because when you see these in the right place, very, very important. Now the upthrusts. Upthrusts are there for a good reason, and that is to trigger stops in a weak market. Remember the word that I just used there, a weak market. We don't want to see upthrusts in a bull market because they're not genuine. They're a polar bear in Hawaii, as you used to say, Tom. Now,
Yes.
what does that mean? Well, it means they're in the wrong place. If you're on the beach in Hawaii and you're sunbathing, and you wake up and look up, there's a polar bear standing over you, two things have happened. You've had too many martinis, or it's escaped from the local zoo. But it's not supposed to be there. Mother Nature did not put polar bears in Hawaii. Now, if you're in the Antarctic and you're in your tent and you poke your head out and there's a polar bear, you know it's in the right place. The Antarctic's cold. So we know that an upthrust after serious weakness is in the right place. However, an upthrust after climactic action in a bull run should be ignored because it's not genuine. Philip, you agree?
I do, yeah. Except I would say polar bears only in the Arctic.
Oh, are they? Okay, Antarctic. Well, I'm close, aren't I? I just said the Arctic. Now you're picking me up on small, in a cold, snowy place. How about that? But
Norfolk, Canada.
Norfolk, Canada. Yeah, you get the point. Okay. So, however, many chart patterns look like upthrust but fail to live up to their promises. The upthrust has to look right. It has to be in the right place. Many are created in a strong market by gapping up at the opening, then falling off to rest, only to carry on up. The genuine ones are easy to see, as we're going to show you. Basically, you should have sign of weakness in the background, not sign of strength. Let's repeat. The genuine upthrust has a sign of weakness, just like no demand, in the background. So, Philip, look at this chart here that I've got. Now, we've got the mushrooming over at the top. We've got some very serious weakness on the bar that I've pointed the arrows at initially there. That's a very nice weak bar because it's approaching an old top. It's a wide spread, but it closes in the middle. Now, that's very important. And the next bar is down. Why is that important where the close is on that bar, Philip, on that volume?
Well, the fact it's closed in the middle shows that that volume must have contained a huge amount of selling, because otherwise it would have closed right up on the high with that wide spread. So there was clearly, when you see ultra high volume, there's a lot of buying coming in, but if you see it close in the middle, there must also be a lot of selling as well, and that selling is absorbing the buying that's coming in.
Yeah. Now we notice here as well that we've got this mushroom. So we are definitely in a downtrend.
Yes.
Because we've got weakness on the bar marked, and we begin to go up on no demands. Now, as we fall to this level here, we get a very, very nice no demand bar, one of the best I've seen for many, many a year. This is a beauty, isn't it? See, it's in the right place.
Absolutely.
Narrow spread, close in the middle, next bar down. However, the professional money will send Tom a telegram, will send all of us one, because they say if you missed that, if you didn't believe it, and you've seen this weakness, you've seen it come off, you've seen no demand, we're going to give you a third bite at the cherry, and here it is, there. Hidden upthrust on very low volume. Now, talk a little bit about that bar, Philip, because you can see upthrusts on high volume, which I know shows a lot of selling because it closes on the low. But when I see a low volume upthrust bar like that, it tells me that as the price is pushed up, professionals aren't really involved, which is why it collapses on the low, hence the low volume. Talk us through how you see that a high volume upthrust compared to a low volume upthrust. What are the differences?
Well, the high volume upthrust is telling you that there's selling or supply by the professional traders on that bar. A low volume upthrust is telling you that the professionals are not interested in the upside on that bar. So if volume is low, there may be some activity by the herd, a small amount of activity, but there's certainly no interest by the professionals.
And we notice two other principles on here that we're going to come to. We see a wide spread down bar here closing right on the low on very high volume, and we see it again here. But the close on the low is the key. Why? I mean, what happens if it closed up in the middle here on that volume?
Well, if it closed up in the middle, there must have been some buying coming in for it to do that.
So really here, we can infer that because it closed on the low and tries to go up on no demand, then you get another one and it goes up no demand up. If you see that after that weakness, that's a very high probability trade to the short side.
I'd say the first one you've highlighted there is actually the weaker of the two bars.
This one?
No, the one just to the left of that one, the down bar that you're highlighting.
Because it takes out this bar here.
It takes out the support to the left, and there's an increase in volume. It's not ultra high volume. Well, it is ultra high volume on the program, but if you're comparing it to all the other bars on the chart, it's not the highest volume. there's enough effort there to push down through the support level without it being too much.
And it does. It closes on the low and there's no demand there. So here is a setup that you must learn and take in, because if you see this is a currency contract, okay, it's currency futures, but this is, again, can be seen in stocks. I've seen it in, we saw it in the gold market when everyone was bullish gold. Similar thing happened. We get a wide spread up, closing in the middle. Now the close in the middle on that ultra high volume should get your trading antenna saying, hey, something's going on. What's going on here? The next bar closes lower, as we can see. So we know there has to be more selling than buying in here. We move sideways initially. Okay, that often happens after weakness. Okay, that often happens. It just goes sideways until we get the sudden surge down, which is what I like to put sell orders in below these areas here. When I see high volume like this, put a sell order in to get pushed in on this bar here. That really means that I'm not getting whipsawed around, because I know there's sellers there, and if they're going to push it through, they'll use this tactic here. Widespread down, closing on the low. Now, Alan's asked, Philip, can you repeat for us what the difference between a high volume upthrust is and a low volume upthrust, and be very clear on it so everybody's got it. What you're seeing on your chart in this example, by the way, is a low volume hidden upthrust. It's hidden because it closes lower than the bar behind it, but what makes it an upthrust, the high of the bar is higher than this bar here, the top, and the volume though is very, very low. And if you think about the price action and what's going on, the price has tried to push up, the volume is declining, and then it's just collapsed on the low with the next bar down. But just repeat, just so people have got that.
Right, the low volume upthrust shows that there's no professional activity on that bar.
Right.
So it's been marked up probably at the open, perhaps there's some news or something come out. The professionals are not interested in that bar, so if they withdraw their interest, the price just collapses down to the low. Right. Now, with a high volume upthrust, the professionals are actually selling into that bar, because an upthrust, remember, is going to close near its low. So the fact it gets marked up at the open and collapses down to the low on high volume shows there must be selling or supply coming in on that bar.
Well, let's have a look at a high volume upthrust then in gold, which we just talked about. Now, again, you've got the same principles here. Now, Tom, many traders think they're great traders when they put their stops nice and close to the market, because they're taught money management and risk. And hey, guess what? If you take a trade in the S&P, be 4 ticks away from the live edge, and then after 15 stop outs and their account gone, they say, oh my goodness, what just happened? But the upthrust is what is used to catch them, or indeed the opposite, a shakeout.
Yes.
Now, tell the listeners here why the upthrust is used, and why, when you see it in the right place, it gives you a real clue as to what the smart money are up to.
Well, the upthrust, once an upthrust appears, after, you keep saying this, after you've seen weakness in the background, then that's done deliberately to catch the stops. Remember, there are not hundreds, but there are probably thousands of stops above and below these actively traded markets. It pays to mark it up, trigger all those stops off, encourage people to go long in the weak market, panic those people to sell already short, and it goes on and on. It's very, very profitable if they can do it. Not always the market conditions allow them. Don't forget, it can cost them money if they're not careful. But that's the upthrust. And if you've got weakness in the background, it's a sure sign of confirmation of more weakness.
At the moment, we're focusing on weakness, okay, and here we see a widespread down bar. Now, this was gold futures in 2008. We saw almost the same thing 2 years later, because the markets work the same way. Get everybody bullish gold, tell them the dollar is weak, where the dollar is now strong. I mean, they all work in alignment. This is why, if you look at the dollar against the pound, it's strengthened massively over the last 6 months. But if you read the newspapers, Bernanke's going to kill the dollar. Well, sorry, not at the moment he's not, because the chart tells the truth. The gold market apparently was going to break and just keep going and keep going. But we all know at some point, just like the oil market, they're going to catch you. Here, what they did is look at the volume on this bar. It's the highest volume. It comes down, closes on the low, and then goes up on no demand. And then they give people hope. They say, okay, well, anyone that's long in here, okay, we don't want you to sell yet, so we'll bring the price back up into this bar up here. So you think it's going to go up, you can add to your position, it's a breakout, and look what happens. It closes on the low, the volume is the highest, and the next bar confirms it. That is an ultra high volume upthrust. It's the opposite, okay, to a low volume upthrust, and that is actually an ultra high volume hidden upthrust because it closes lower than the bar behind it. But notice that the high of this upthrust is higher than this bar here, and actually what is interesting, it's into the body right of this bar here, which is a serious sign of weakness. Okay, is there any questions on that one? If not, we're going to go straight to, well, this is the same principle as well, look. You've got all the principles here. You've got sign of weakness in the background. In fact, Rich, if I could ask Philip, this is one you, I know, selected. UK land, it's a FTSE stock. Do you want to talk us through the yellow area first, and then the reaction at A and B, which are both good upthrusts?
Well, this is one of the largest UK property companies, British Land, which has been around for, I think, over 100 years. And if you look at the yellow area on the left of the chart, you can see Gavin has highlighted the up bar, which is on very wide spread. It goes right up near the highs on ultra high volume. Now, for that to have been buying, if that was all buying, you wouldn't then expect the next bar to be down. So the fact the next bar is down is telling you there must have been supply in on that bar. And as you can see, the market then comes off from there. When we go over to point A, we've got a lovely example of an upthrust where we push back up into that area again. The market has rejected it. What's happened is you've got, is that low volume on there, Gavin? Or?
Yeah, it's pretty low.
Pretty low. I think it's the blue one, isn't it?
Yeah, these are both examples of low volume upthrusts.
Yeah, they are. What's actually happened there is that the professionals have done their selling back in the yellow area. The herd have done their buying. And then when you get to A, there's no more buying orders left from the herd. So the price gets marked up probably on some good news. There's nobody who wants to buy in the herd. The professionals are not interested in buying, certainly at that level. So the price just collapses back onto the low on low volume. And B is just a repeat of that process. So
it's interesting, but so professional money are supporting at this level here, but they're not interested in higher prices here, and actually after B this thing collapsed.
Yeah.
But it was interesting, it went in phases. Okay, because if you'd have gone short on that upthrust, when it comes down to this bar here, okay, we notice we get a little test bar. I think it's in there. It's a little bit of buying. They support it, bring it back up, and then bring it back down again. That's why a market sometimes can be very devious. And that's why you've got to watch, if you're on a daily chart, you'll see this is actually a sideways moving market, but eventually after B it did collapse and fall, didn't it?
They're probably doing a little bit more distribution, because I'm looking at the bar before B. That's an up bar, and that shows a little bit of selling in there. So I suspect that they still had a little bit of selling to do, which is why they were holding it up.
So let's just summarise. Shorting after you've seen an upthrust. This can and does appear in an uptrend, but is not a genuine upthrust because you are in an uptrend. It is a far more powerful short in a downtrend. Do not short an upthrust in an uptrend. It's in the wrong place. Remember that. This is a powerful short when there is a downtrend in place and you see this push through the top of the downtrend channel. Now remember, when we're in a downtrend and it tries to push up through the top of the channel on high volume or low volume, and it's an upthrust, it's a serious sign of weakness. You must have weakness in the background.